You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. If you trade options, you've got to ask yourself, why would you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So, don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees. And it's the only options trading platform where you can earn a rebate on every contract traded. To learn more, please visit public.com/optionsbootcamp. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means we are back. It is Wednesday. It is Education Wednesday here on the network. Time to roll out a little bit of the old OBC. In fact, Education Wednesday now the newest doubleheader Wednesday on the network because, of course, right after this show, I'll be diving headlong into the newest addition to the network, the Futures Rundown. Yet another compelling argument, listeners, for why you should be listening to the full network. I mean, if you like OBC, we love you. We love you all out there. But you should definitely be listening to the full network. So wherever you're getting this, Apple Podcasts, Spotify, YouTube, wherever, make sure you're listening to the full network. That's where you're getting all of the goodies. Of course, if you can't find something for whatever reason, our website has it all, as well as, of course, our mobile app in all the major app stores. Every episode going back to the primordial ooze days, the day when we literally birthed the options podcast genre back in January of 2007. So check it all out. And if you like what you hear, throw a like, a star, a comment, just like this week's 5-star review coming from Andrade. Maybe Andrade, one or the other. He just says, thanks, learning a lot. Well, you're welcome. Man, a few words. I can respect that there, Mr. Andrade. Or perhaps Miss, we don't know. Either way, thanks for taking the time, everyone out there who rates and reviews. It does help a lot. Also, make sure you're checking out our friends over there at public.com/optionsbootcamp, the easiest way to go and support the show. Just by clicking on that URL. Lets them know you're coming from OBC. Keeps this show coming at you for another decade or so. And I am joined this week by my compatriot in all things options, boot camp, crime, Daniel J. Passarelli III, Esquire, a.k.a. the guy the kids call Sergeant Passy. How's it going, Sarge? Welcome back to the show.
It is going great. Another week, another $1, or hopefully more.
Just one? I was going to say just one. You know what? You're getting that payment from Uncle Mike. So that'll be $2 plus interest. So
Oh,
You know,
yeah.
you're sitting pretty this week,
idea.
sir. You're sitting pretty. As we keep on rolling, listeners, right on into a little bit of the old options drills.
Holy mooch! Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, let's do it. Let's commence a little bit of options drills. And this options drills, in fact, all the topics on the show this week were inspired by your questions. You folks are the best, after all, bringing it week after week. And this week we got a question from Mikey Tom. So a man of two first names. One first name wasn't enough for him. He had to go for two. He says, can you go over again those tools you use to evaluate skew in the S&P 500? Thanks in advance for your time. Well, you're welcome, I should say, in advance before I even get into the question. You're welcome there, Mr. Mikey Toms. Let's get into this a little bit. I thought it was a worthwhile topic, Dan, for a little bit more exploration this week on the old options drill segment, because it is such an important topic, especially right now. We are recording this, listeners, partway through October. We're getting one of those Rocktober seasons again. Vol is creeping up. We are, of course, heading into a presidential election. Now, I know many of you will be listening to this show weeks, months, indeed years down the road, so things might indeed be different when you're listening to this. But any environment where skew's getting a little juicy, vol's getting a little firm, it's worthwhile to remember a little thing called skew. So let's get into that, and then, Dan, I want to get your thoughts as well. Again, I touched on this a little bit last week. I'm going to go over a couple of tools that I use to evaluate skew. One of them is a paid premium tool. One of them is freely available. And then I want to get Dan's thoughts on how he likes to break this down as well. Because, again, it's important. If you're looking at this right now, you're looking at the market. We're kind of vacillating these days. We're seeing a little bit more red on the screen right now. People are starting to get a little bit nervous, a little bit top-heavy maybe in certain major indices, or perhaps in single names, depending on what you're looking at out there. And you're saying, maybe you might want to think about hedging some of this stuff. And then you go look at the prices and you're like, whoa. So some of these tools might help you navigate that a little bit. Let's get out first to the premium one. If you listen to our option block show that we do twice a week, Monday with our friends over there at Public, who are also on this show, as well as, of course, Thursdays with our friends over there at SIBO. I bring up the Thursday episode because we are joined on those episodes by our pal there, Mr. Henry Schwartz, the Flow Master from SIBO, who has created an awesome tool that I have used for years, and I think many of you might want to check out. Again, if you're looking to invest a little bit in your trading, it is called Trade Alert. We use it to analyze all different types of flow, a lot of the unusual activity analysis that we do on the network, whether it's on the option block, whether it's on options. It starts in Trade Alert, then we kind of spread out from there. It's a great tool for really analyzing just about every aspect of the options market. You can design custom scans, whatever the hell you want it to look for, it can pretty much find. It's got 13F data and all kinds of stuff in there. So it's really a massive, mostly institutional grade tool. So it's not really for all the retail out there, but it is a useful tool because if you fire it up, you can look at things like this. And I pulled up SPX right before the show, listeners, and it's showing me one of the great things it does is it gives you context for where the skew is hanging out right now. The 30-day skew right now in the SPX, a little bit north of 37%, 37.1%. That puts it at the 95th percentile for the year. Now, that's not for all time. This is just for the year. So it's a more immediate context that you're getting here, listeners. Actually coming down a little bit. It was the 99th percentile when I checked it earlier this week. So we have come in a little bit. Could be a little bit of moving frame of reference there on the year as well. If you're wondering, you're saying, Self, when were the high and low periods over the year for skew? Well, luckily, I can find that data for you as well. The low period for skew, the low water mark, was 13.2% in the S&P. That came on February 23rd. Then we're talking about premium for skew. It's worth noting. When you talk about equity indexes, you're talking really about the level of vol in the put wing. That's really what people are gauging on at the end of the day. So it's really shorthand for how expensive are the puts. There could be something going on with the calls, but 9 times out of 10, it's really going to be the put wing. That's the driver. And the height for Skew. Dan, I'm gonna let you take a flyer on this one. Take a guess. What day this year did put premium in the SPX get jacked to high heaven?
Well, I'm going to go with, it's funny, I was just looking at a chart of SPY, thinking about a very similar concept, and I'm going to go with August 5th.
Oh, you are a genius, sir. They don't call you Sergeant Passy for nothing. Yes, August 5th. You don't need a tool to tell you that one, listeners. August 5th. It was at a pretty whopping nearly 50%, 49.4%. So you can see at 37%, we still have a little bit of ways to go there in terms of climbing that wall of worry. That also shows the high water mark for the year is pretty darn high. In order to reach that 99th percentile or closing in on 100, you really need to get close to the levels we saw on August 5th. It's not a thing we want out there. So that's one frame of reference. That's, again, the premium tool. I'll get to my free tool in a second. First, Dan, what are your thoughts here for how you like to evaluate Skew, if you want to share that with our listeners, sir?
Well, keep in mind that whenever I'm analyzing any option trade, I'm analyzing the volatility as one component of that, which helps guide my strategies. When volatility is higher, I lean more towards selling options. When it's lower, I lean more towards buying options. And then when we get skew, like vertical skew, and the puts get more and more expensive relative to the calls, it just gets better and better to sell those puts. And, I'm not going to say that it's an easy game, because you get a situation like August 5th where selling pressure is kind of exacerbated. It can blow through your strike. But if you're willing to bottom fish a little bit for dips, you can just get these really nice juicy premiums when you're paying attention to how expensive the puts get.
Yeah, that level of volatility is going to be an important contextual tool for how much it's going to cost you, listeners, to buy protection. Anyone can go out there right now, just look at very obvious bellwethers for vol, like VIX Cash, for example. We've all seen it tick up back over 20 in the last week and change out there. So that's your first clue that maybe things are going to be a little bit juicier out there when you're coming to pay for protection. So now we're kind of having the double whammy, listeners. A vol in and of itself is ticking higher, which means to buy puts going to cost you more. On the flip side, Dan was talking about selling puts. Could be an attractive time if you've identified a level you don't mind picking up a little bit more S&P to the downside. Could be an attractive time to sell some of that. But we're talking about buying here right now. And then the flip side of that is also going to be, in addition to the level of overall vol, you also want to see how pricey those puts are. And that's what these tools are we're talking about now. I mentioned this last week. And this is a freely available tool anyone can access, in addition to whatever broker you're using, what tools they have. Let's go out to, it's cmegroup.com. You all know CME. Just their website, cmegroup.com. They run a report called This Week in Options or This Week in Futures Options, TWIO, TWIFO. Those both should get you there, listeners. They may ask you to sign up for an account, which is free. Takes about 2 minutes to sign up. Then you have access to everything CME offers. They have a lot of great educational content there. So I'd recommend you probably do that anyway. But once you do that, that gives you access to our This Week in Futures Options reports, which we use in conjunction with our appropriately named This Week in Futures Options show on the network every Thursday. Again, another reason you should be listening to the full network. But these reports are awesome, and they're running 24/7, 365, listeners. So if you want to check S&P Skew on midnight on a Saturday, you're spooked about something happening on the weekend, you can do that. It's running out there for you. No one's going to judge you, at least not on this show. So go to that report, listeners, cmegroup.com/TWIFO. Then you're going to go into that drop down at the top there. You're going to go down asset class. It's an alpha order list, so just scroll down forward / to equity indexes. Then you want to go product family, U.S. indexes. That's where we're looking, obviously, the E-minis. And then we're going to go into the S&P 500 E-mini. Now, it's not SPX, but S&P E-mini is going to have the same skew setup as everything else out there, as SPY, as the SPX. Might be some minor nuances between the two, but at the end of the day, you're not going to see puts jacked the heck in one and offered in another. It's not going to happen, listeners. Little thing called arbitrage keeps these things in line. So if you run that report right now, you're looking at it for today or whatever day you're trading, listeners. As of right now, you'll see not only is the overall level of vol ticking up, but also that skew was already rich last week, and it is continuing to get bid up now. If we go into, let's say, the dailies everybody likes to play in right now, expiring today, expiring tomorrow, those puts were anywhere from 11 to 12.6% bid, and now coming into today, that was a week ago, now today, they are 14% bid. So those are ticking up. We go a little bit farther out, let's go a week. The puts that are expiring in a week, they were 13.7% bid 1 week ago, so 2 weeks out. And today they are 18% bid. So that's premium on top of the at the money vol level, listeners, that you are paying for that 25 delta put. So again, you could just look at this chart and say, oh yeah, there's something afoot here. You scroll even farther out, you go out 20 days, those puts 22.7% rich. They were 17.3% rich a week ago. So the trend is not your friend here if you're looking to buy some protection right now. You go out 23 days to the contract expiring November 1st. Those puts 24% bid. They were 19% bid a week ago. So we are just ticking up across the board. I keep scrolling all the way out. I don't see any part. Just gets worse. If you go out to you go all the way out to June of next year, those puts 28% bid, listeners. So yeah, that bid is there and it's persisting, at least for right now. So another tool anyone can access, completely free. It's going to show you not just where we are right now, but also how much that skew has changed over the past week. So a short frame of reference, but it'll give you an indication of how it's looking. You can also look at the entirety of the term structure. So that will give you a full snapshot of how things are going. You can repeat this. You can go out to the NASDAQ. You can go out to the Russell, whatever equity index floats your boat. It'll be there. So something you can do very easy, very free. I still say for my money, this quick skew number and the evolution of the quick skew over the week is kind of the best skew tool in the game. In fact, Nick and his team know that. They're working on making one for equity options that you folks trade all the time. It's not ready yet. It's still kind of in beta. But when that comes out, you can get these numbers for your Teslas and NVIDIAs that you're all sling all the time. So that'll be a very cool addition. So I've been looking for that for a while. But right now, it's still mostly for major indexes. But again, one premium tool, one freely available tool that anyone can use to evaluate skew. If you want to go deeper with this, you can go in and upgrade to Bantix. That's what the company is called, Bantix. They make this quick strike tool. They create the free one. There's a premium one you could log into, and it's not that expensive. And that will give you access to the history for quick skew as well. So you can see a graph and how much this has changed over time. So if you want to go farther back and really see how the current skew environment compares to, let's say, 6 months ago or 3 months ago, whatever the case may be, you can go do that as well. So again, two great tools that'll let you do this on top of whatever your broker is bringing to the game. Dan, anything else you want to add before we tackle a few more questions, sir?
No, but that is really a super powerful tool. I love that. Very, very great.
You know what else is great? Is some mail. So let's get to it now. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, let's get to it, listeners. Let's break down. Well, before we get to our question of the week, you folks are all waiting with bated breath to see what Sergeant Passy has up his sleeve. So without further ado, it is time for the Market Taker question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker question of the week.
All right, Senor AP, what you got for us, sir?
All right. Well, I was thinking about this. I asked myself this question. I was thinking, increasingly, we've been finding better straddle trades, which is weird. And Matt from ORATS pointed that out as well, if I'm not mistaken. Usually when we do our total earnings domination earnings trades, we're usually doing time spreads, but there's been some more straddle candidates. And so I had to ask myself why. And my theory is that there's just really a lot of vol selling funds out there. And that's why I literally had my eye on August 5th as we were, as you were asking me a different question that, had to do with that date. But that's probably why that move got exacerbated, because there's so much big money short volatility. And so, they had to delta hedge. And that would explain why we were seeing more depressed implied volatility levels relative to historical volatility. So that has kind of a lot of implications, and we could do a whole show about that. But yeah, I just figured I'd throw that out there and let that stew for a little bit.
So you're saying your love of straddles is only growing, sir?
It is.
Start calling you Dan the Straddle Man if you're not careful out there, sir. Dan the Straddle Man. Why is he so tan? I don't know. We'll just throw some rhymes out there, listeners. That the tanning mecca that is Frankfurt, listeners. Let's look at some of our own questions of the week. Let's pay off the one from last week here. We said, hey, the election is looming. What is your trading plan through election day? Quite simply, gave you 4 choices. Stay long, stay the course, so no real change. Or get flat, go to cash. Or you're looking dire, you're saying go short, or really aggressively hedge your portfolio. Or trade small, intraday only. Mr. Dan, if you have a thought, have at it. And B, which way do you think our audience went?
Well, I do like keeping positions pretty short these days, which is one of the reasons why we introduced our zero-day option trading scanner. I am somewhat in cash, I'll tell you that. I'm still doing my thing, but I'm keeping it shorter and smaller and keeping a little less on the table. I guess I'm kind of doing, a number of the choices here.
Our audience was pretty split. It ended up stay long, stay the course, took it at the end there with 39.3%, but it was a tight fight for most of the week. Trade small, intraday only was kind of neck and neck there for a while too. It ended up coming in at number 2, 32.1%, 21.4% for get flat, go to cash, and then 7.1% going to the dark side, saying you're getting short or hedging your portfolio. We got a fun one going right now, listeners. We say, we're a month out from the election. A lot still has to unfold between now and November 5th. However, when the dust settles, where do you think VIX is going to be the next morning? So immediately after the election, Wednesday, November 6th, listeners. We gave you 4 relatively wide ranges to sink your teeth into. Around here, 18 to 22. A little higher, 22 to 26. Still higher, so north of 26 or below 18. Mr. P, where are you falling? Where do you think our audience is falling?
I will say on November 6th, the day after the election. Well, you know what? I'm not going to speculate what I think it'll be. I'm just going to tell you what I hope it'll be. And I hope it'll be back down below 18.
That is kind of the rational selection, is it not? That's how it would work in the days of old before we had, months of turmoil after every election and contested votes and everything else. So, yeah, and our audience agrees with you. 42.3% right now, Dan, saying back down below 18. Then 26.9% for, going to be higher, 22 to 26. 19.2% say vol's still jacked north of 26. And 11.5% say somewhere around here in the 18 to 22 range. At Options, the place to go to make your voice heard this week, listeners. And pretty much every week, there's a question of the week there. So if you listen to this years down the road, there'll still be a fun question of the week ready for you to vent your spleen on, listeners, if you are so inclined. Did I tickle your funny bone there, Mr. Dan?
Yeah, that's pretty funny.
All right, let's keep rolling. Let's go out to Avery. Let's see if Avery can do the same. Avery has a question. Oh, this is one we talked about a few weeks ago. I wanted to come back to it. She said, can you explain pattern day trading rules? Are these something that options traders should be concerned about? You know, this question sounded kind of familiar to me. I wanted to go back into the archives to check. And that is indeed the case. We did talk about this not that long ago, Dan, here on the show. I thought we had a whole episode about it. I wanted to go find it for her. Of course, Avery, like a lot of our listeners, probably newer to the game, newer to the show. Maybe you don't have time to go all the way back into hundreds of episodes. I get it. But if you do a little quick search, you could find this, listeners. There were 2 episodes that we talked about this last year, actually. One less than a year ago and one a little over a year ago. First off, episode 252, Day Trading Dangers, in the title there. Put Problems and SIPC Solutions. That was from August 30th of last year. And then episode 263, What the Hell is a Jade Lizard? We had our friends from Tasty on the show with us that week. That was from November 15th of 2023. And we went deep into pattern day trading there. I'll give you the crux. I want you to go back and check out those episodes because we kind of go deeper. In fact, we have a kind of beam in from an additional person talking specifically about the nuances of pattern day trading. But the gist from those episodes were, in the past, you know, if you, again, this is all for accounts under 25 grand. So if you're over 25 grand, this doesn't really apply to you anyway. But for those smaller accounts, which I get it is for a lot of listeners of this show, you will be flagged for pattern day trading if you make more than 3 day trades in a rolling 5 business day period. It used to be no big deal. You got a flag. You can usually call up your broker and maybe they'll give you a reset. Worst case, you had to kind of sit on your hands for 90 days. Then you're right back at it. And people wrote in when we were talking about this last year about all sorts of workarounds. You can use the E-mini to get around it and all sorts of other things. So it never was that big of a deal. But the interesting thing we talked about on the show a little less than a year ago was that seems to be changing. FINRA didn't change their rule, but they're changing their interpretation of their own rules. And we had the CEO of Tasty Trade on the show with us actually to discuss it because their new interpretation is actually relatively draconian. And it used to be you got that one hit, you could get a reset every 90 days and things were kind of good. Now it's 1 violation per account. So it's essentially 1 strike and you're out. So if you get violated, you get flagged for this. Then if you do it again, you're done. You have to effectively close your account with that broker, it seems like. Now you can go out and go move and make a new account with a new broker, but that's not ideal for you. That's not ideal for the broker, clearly. They don't like this, which is why the Tasty CEO was up in arms about it. So if you're done with that firm at that point. So that was seemingly oddly draconian and punitive to me. This was last November, the last time we checked in with the FINRA status of this. I might need to go do some more digging to see if things have changed. Again, I encourage you to go listen to both episodes. We go much more into detail on them. But short answer, yes, it is something you need to be aware of if you're an options trader. And maybe more so now than ever, unfortunately, especially if you're in that camp of the 25K and under. Dan, anything to add on the unfortunately draconian nature of pattern day trading these days?
Yeah, I mean, it's a not very well thought out rule. That is one rule that probably hurts option swing traders more than any other dumb rule that I can think of, because it ties your hands to risk management. Like, you can't manage your trades responsibly all the time if you have to wait a day. So yeah, it's an unfortunate rule, and it's just not very well thought out. I don't know.
Yeah, why would you want to close out your trades? I mean, who wants to do that? Right. Why would you do such a thing? Not surprisingly, we polled our audience on this last year. We said, is the pattern day trading rule a necessary protection for retail traders or an outdated concept that needs to be updated or removed? 84.8% of you said it's outdated. Only 15.2% said, yes, it protects traders. So, yeah, no love for it. I need to do some checking to see what the status is, if FINRA has maybe rolled that back a little bit. But you should be prepared for this if you're trading in an account under 25 grand, listeners. And again, go check out those episodes for more details. Let's go to this one here from, I like this handle, Machine Head. All one word. Machine Head says, I know Mark and Dan don't like naked short units in trades. Well, that's good, Machine Head. You've been listening. But what about legging into a butterfly where it's just the long leg and then the short guts. So buying one, selling two, listeners. Effectively a ratio spread. Then you wait and see if you need to buy the final leg to cap the risk or if you can ride the trade for a much lower outlay. All right, so Dan, he wants to get cute with it. He doesn't want to buy the full fly. He doesn't want to buy that upper leg that you buy to protect yourself in case the worst thing comes to pass, right? He wants to just do the ratio, buy one, sell the guts, and then let the dice fly, sir. What do you think of that?
I mean, waiting to see if you need it, that's kind of like you're on a road trip, you're looking at the gas tank and you think, I don't know. Let's just wait and see if we need gas. If we run out, then yeah, we needed it. Because, you're only going to know you need that call when it's too late. So I don't know. I'm not necessarily a fan of that. A lot of stuff has to go really, really right. And it doesn't go that right that often. I think you'd get really frustrated trying to trade that, serially. Yeah,
because it's not even a butterfly at that point. It's a butterfly maybe in intention, but it's a ratio spread with short units in reality. And that's going to come back to bite you. If you might say, I'm going to put a butterfly on eventually, but who knows how often that's actually going to happen. So yeah, I don't think Dan and either of us are fans for that, but thanks for writing in. Great handle there, Machine Head. All right, Dan, since you're Mr. Straddle, we'll get out of here on this one. We'll do one more just for you because you're loving Straddles so much this week. Let's go out to Elizabeth, and she wants to know, so if long straddles are so dangerous and difficult to profit from, doesn't it stand to reason that short straddles will be very easy to trade and very profitable because you are collecting all that decay? Well, Dan, if you can't buy a straddle, just sell the hell out of it, right? That's easy. That's a road to riches, is it not?
Well, I tell you, I am giving Elizabeth credit for in some ways thinking about it the right way. If long is not good, then short must be good, and there's a little bit of logic to that. But the problem is long straddles, just end up being like a slow, painful death. Because historically implied volatility has been overpriced and it's just hard to find the opportunities. And, even unless it's a really great opportunity that really works out, you're going to lose on most of them. And it's like, oh, lost my theta today. Oh, lost my theta today. Oh, vol's down too because the thing's not moving. Lost my theta today. And you kind of hope for those bigger moves. But, the problem with selling the straddles is that, sure, they probably you will have a lot more winners than losers, but it's that one big loser that's really a kick in the kahunas. Like August 4th of this year would have been an ugly day, or second rather. August 2nd of this year would have been a really terrible day for short straddle people. But, looking at the chart, outside of that, you probably would have had a lot of winning days.
Yeah, it really kind of depends what you mean by the subjective term of easy. Because I don't know about you, Dan, but I knew a lot of guys on the trading floor who would effectively trade this way. They would be short tons of premium on every strike, so they're effectively short straddles. And I've never seen more miserable people in my life, Dan, especially heading into expiration. These were the guys sweating profusely, popping tums, having to leave the floor for a while because they're not feeling well. It's a rough way to make a living. You are going to collect your decay, but you're also going to feel every tick of the underlying in between. Obviously, that's up to your own personal risk tolerance, to what extent you feel that, but every tick of the underlying, listeners, you're going to feel it out there. So if that doesn't sound like easy money to you, then this is probably not the way to go. If you do have to go this way, if you do want to sell at the money straddles, and we talked about it before, do iron flies, cap your risk, and then, hey, go to town, have a good time there, Elizabeth. All right, Mr. Dan, that is going to do it for us on the old OBC. I'm not going to do it for me today on the network, though. Listen, I'll be back in a little bit. So if you're hanging out in the pro, I'll be back in a little bit with the futures rundown for the rest of you. That'll be hitting on demand later today with our guest, Rich Excel. Really knowledgeable guy in the world of futures, so it should be a fun time. And Mr. Dan, before we go, folks want to check out what you have cooking. Where should they go? What should they do?
Sure. We'll welcome you with open arms over at Market Taker Mentoring. 2 T's in a row. And you can contact me there from the site, join our chat room for free, DM me or our other coaches. And we love OBC listeners.
Love them indeed. Know who else loves them? Our friends over there at Public. Public.com/options bootcamp, the place to go. To show your support for the show, just head on over there, click that URL, and then you're off to the races. You can check out the rebate, of course. Kick the tires on their platform. Let them know what you like to see them add. They will be very receptive to what you have to say, and it helps support the show at the same time. Public.com/options bootcamp. That's going to do it for us today. Back again in a little bit for the futures rundown, then back with the rest of our array of content throughout the week until we're back again next Education Wednesday with another episode of Options Bootcamp. And for everybody out there in the range of all these hurricanes, and for everybody in general listening to this show, I say it every week, I really do mean it this week. Stay safe out there.
If you trade options, you've got to ask yourself, why would you choose an options trading platform that puts investors first? At Public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So, don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees. And it's the only options trading platform where you can earn a rebate on every contract traded. To learn more, please visit public.com/options bootcamp. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.